Konnichiwa, I'm Gerhard Hametner. I'm one of the directors here at Mac Sharaf. This is our last research briefing for 2009, so even before I get into this briefing, I'd like to wish everyone a Merry Christmas, a Happy New Year and a prosperous 2010. UAE markets have been weak this week. Started off quite softly during Sunday, Monday and Tuesday trading as brokerage firms downgraded some of the banks in Dubai, including Dubai Islamic Bank and Emirates MBD. So investors have switched from Dubai banks into those in Abu Dhabi. Markets have been very light in terms of trading volume and have been quite tender in anticipation of some news to come out of Dubai World's meetings with the creditors set to have started in Dubai yesterday. The meetings are likely in the beginning of this negotiation process mainly going to be information sharing forums where creditors are informed about the extent of Dubai World's debt, the terms of government support, and the payment of the $4 billion Nakheel bond that was scheduled to be repaid at the beginning of December. As we come end of 2010, you'll notice that research reports that come out about this region will focus on the real volatility that we've seen in the stock markets here and in the economies. You know, this is 2009 has been a year where we've seen $23 oil. Oil has recovered almost 3 times that now, trading above $75 a barrel. The property market correction that has taken place here in the UAE has been unprecedented. But there have been some positive aspects as well. We've seen Abu Dhabi support of Dubai and the other Emirates, and in fact other countries in the GCC. We've seen the launch of the metro here in Dubai, which is just another infrastructure project that has taken many years to complete. And very early on in 2010, we'll see the launch of Emaars and one of Dubai's flagship projects, and that's the Burj Dubai, which will be, at that point in time, the world's tallest building created by man. On the negative news, the analysts will also focus on things like Emaar and Dubai Holdings' consolidation of property companies, which was announced and then recently cancelled, the Dubai World debt standstill, and the continuing ripples of big creditor defaults that have come from Saud and Al Ghassabi that have shaken the credit markets from Saudi through the rest of the Middle East. Looking at the year-to-date numbers, Dubai has really underperformed the MSCI Frontier and Emerging Market Indices. Dubai has achieved a 15% growth year-to-date compared to the MSCI Frontier markets of 19% and the MSCI Emerging Market Indices at 68.4%. And that's mainly due to the macroeconomic risk factors, also to the lateness of the entrance of this part of the world into the credit crisis, and the negative effects that we've discussed earlier today. Associated with that, the net earnings of the top 20 most liquid stocks in the UAE have declined on average by about 45% year to date for the period ending September 2009. And looking forward to 2010, it's likely that global investment managers will reassess their allocation to emerging markets and this frontier market here in the UAE. Looking further abroad and the effect that will have on the markets in the UAE, there is a lot more talk about an emerging bubble in China's markets, some overheatedness in the metals and mining markets related to China's bubble, and the real gains of more than 50% in emerging market indices. So likely that foreign investment managers, particularly those with a global mandate, will look at investing in stocks and countries where stocks are trading at price to book and price earning multiples that are very low historically, and have very clear catalysts in terms of how they will unlock value in the medium term. For all of the uncertainty and risks that have been attached to recent events in Dubai's debt defaults, the low valuation multiples have really factored in all of the negative risk aspects of these things, and that's the reason why we see the DFM trading at the 1800 to 1900 levels that we see now. One good thing that really has come out of the events that have taken place here in the world, but the effect that has had on the UAE markets and in Dubai in particular, is that it will spur a lot of action. and the action will come in terms of a new corporate evolution. We've already seen the announced merger of the Nasdaq Dubai with the DFM. That will bring along many positive aspects in terms of greater corporate disclosure, stronger governance, potentially a new set of listing rules that will allow more companies to come to IPO and broaden and deepen the public capital markets of this region. It's likely also that, with the consolidation of these exchanges, we'll also see consolidation on some of the smaller banks. UAE is a largely overbanked market, and it's likely that only the strongest will survive this difficult time. Looking ahead in the DIFC and in the broader Dubai and UAE markets, you'll notice that the real economy will start to perform quite strongly in 2010, where a lot of the comparative advantages of manufacturing and services in this part of the world come to the fore. And that relates to a cheap currency at the moment. The currency is pegged to the US dollar, and the US dollar is on multi-year lows. That relates to low-cost labor, cheap oil, and in turn cheap energy, and Dubai and the UAE's position as a regional hub, both in terms of the airlines, the ports, financial services, and their domestic railway service. There's no doubt that the excess housing stock in Dubai is going to weigh quite heavily in the next 1 or 2 years. It'll take some time to work this way out through the system, but the upside of that is the support of the rental yields in that market is approximately 6% at the moment, and there is no shortage of foreign buyers in the world who are looking for a tax-free haven and potentially a comfortable place to retire and to park some investments. The key themes for the equity markets during the coming 1 to 2 quarters are really the fact that Dubai and the UAE have been severely hammered because of the news, the flow that's come out of this region in the recent months. This means that the valuation multiples are pretty much as low as they've been during this whole credit crisis cycle, and if one can pick up quality companies that have good diversified exposure throughout the region, it could be a good entry point for investors. So really the themes are: 1, long-term regional exposure, and there we look at stocks like the DFM, which attracts investors particularly from the GCC region, and it's the only listed exchange in the region where you can get exposure to the real economic growth of the Middle East. Arab Tech, which is a construction company that has an exposure originally mainly to Dubai, but has recently been diversifying away, particularly to places like Saudi Arabia, Qatar, Kuwait, Algeria, and Russia. MR has ventures in India and should be considered quite a good diversification away from true Dubai exposure, and the same can be said for companies like DP World, GulfNav, and Dana Gas, which have got quite global operations. The second aspect that we need to look at is good dividend yield stocks, and if you do go onto our online research portal, you'll be able to find information about the dividend yield. But they're the stocks that we favor include Air Arabia, Aramex, Agthia, which are 3 companies that have the cash on their balance sheet to be able to pay shareholders who will demand it in the first quarter of next year, and have historically had the habit of paying good dividends. Earnings quality will be the third aspect that you need to focus on, and there you'll see some common stocks that relate mainly to the things that people must have, and those 2 things are communications and banking. The strongest banks that we favor are National Bank of Abu Dhabi and First Gulf Bank, those banks in Abu Dhabi which have seen the receipt of the main investment funds that have flowed towards banks in the UAE. And then of course Etisalat and Du, both with solid subscriber bases in the telecommunication spaces, and also both expanding quite aggressively into other markets. That's all for us for this week, for this year. Happy investing, Merry Christmas, and we'll talk to you again next year.